So, I'll try and paint a little bit of a more detailed picture of the sugar sector and the sugar market for 2026. Jim covered a lot of material that I'm also going to talk about, maybe in a slightly different way, but the same essentially story comes through, and so that'll set up a good session for questions and answers at the end here. Where to start? Make sure it's showing. Okay, so we've got challenges ahead. You got net farm income is tight, as we've talked about. It's a squeeze between prices and costs. We've got an oversupply of sugar in the U.S. market. We've got falling consumption, both here in the U.S. but also globally, and that's going to push downward on prices going forward. And of course, where we're at right now with prices is not in a good spot. Jim just mentioned it, and I'll just cover some basic U.S. ag economy points as well. What have we seen from livestock and crop net farm income? Going back to 2012, when we saw a good run-up in farm income. So since that time in 2012, of course, we had a drought then, but it also resulted in at that point in time, historic prices for the crop sector. Since that time, we've seen livestock returns go up almost 30%. We've seen crop returns go down 25%. So this is a tale of the two sectors that we hear about sometimes from the Farm Bureau, in the sense that we've seen this divide occurring, and it continues to spread. When we dial in a little bit into essentially the different crop sectors, don't have sugarcane or sugar beet on here because USDA no longer surveys sugar crops for their ARM survey each year. But looking at these crops, essentially going back to the last Farm Bill, you can see how net farm income has fallen off. These are dollars per farm. Obviously, cotton being an outlier here, we had the run-up in 2021, but since that time, falling off the cliff. Wheat, corn, and other specialty crops also down since that time period. At the same time, we're seeing one of the contributors to that is higher expenses. Again, a lot of different ways to show this, and I'll dial in a little bit using some of the material from LSU and from the University of Minnesota for sugar beet and sugar cane farms. But on average, since the last Farm Bill, you can see what expenses have done for all farms across the U.S. with interest rate certainly being up 25% since the last Farm Bill, and almost all the other commodities up as well. You can look at dollars per ton for fertilizer, whether that's phosphorus or nitrogen products, or dollars per gallon for diesel, for farm diesel. And again, this sort of paints a similar story. Things aren't quite as dire as they were 2 years ago when we saw a huge run-up in costs, these costs in particular, but still significantly above where we were at the last time that we enacted a Farm Bill. And that was one of the reasons why we had been pushing in Washington so hard to get a new Farm Bill done. That the OB3, as Jim mentioned, that certainly improved loan rates for sugarcane and sugar beet, but also addressed a lot of the Title I commodity programs. But as you see this price-cost squeeze and tightening farm income, what do you see from banks? And we're seeing, this is a set of banks from the Kansas City Fed that they survey, and that you can see an increased expectation of asset liquidation occurring to finance operating loans to keep farms in operation this year. There's been a lot of discussion about how difficult it is to secure credit for the upcoming farm season. As Jim mentioned, if we don't see something turn around this year, it's going to be even worse next year. But I like the optimism in the sense that hopefully next year we'll be here talking a little bit slightly more optimistic story. But certainly you can see the demand for loans also increasing year over year across all of these districts. I would say likely also for down here in Louisiana. Jim had mentioned that we are seeing some positive signs, though we're likely to see 2 rate cuts at least. I looked this morning, it was actually a 70% chance that by next December we're going to see lower interest rates by 50 basis points. This chart just shows where inflation is expected to be headed by the Federal Reserve, as well as where their governors are voting on where their rate policy should be over the next 2 seasons. So you can see, I've put a little circle box there on the right-hand side that shows where the votes are for rate cuts in 2026 and 2027. And you can see the bulk of the governors are voting for lower interest rates going forward based on today's economic fundamentals. Overall crude prices is kind of a double-edged sword, and I've talked about this before when I've been here. Obviously, lower diesel prices is good for farm operations, for sure. But certainly, we also know that for countries like India and Brazil that put a lot of sugar into ethanol production, if you see lower petroleum prices, that means they're going to be using less of their sugar cane for ethanol production, and more of it's going to end up on the world market, which is going to keep damper on future prices. So right now, the Energy Information Agency is forecasting flat to slightly lower prices going out into 2026 and up to 2027. Here's what I think that, and certainly when I was at USDA as the chief economist looking at conditions that in good times and bad times, I would certainly always look at what farmland values were doing. Why is that? On the right-hand side, it just shows the equity side of things. You can see the 80s, we had this big fall off in equity, which led to a very disastrous time for agriculture. And right now, we're certainly at record levels of equity, and that's financed primarily by farmland values. So if you look at where you might be worried, it would be when we see farmland values starting to decline, go negative in terms of year-over-year changes. The left-hand side here just shows where we're at right now in terms of the increase in land values across these Federal Reserve banks. Now, right now, it is still positive. So farmland values are remaining high and are actually going up in some cases. When those start going negative is when we're going to have a real problem. So if I look at the data that's published by Mike there in the back at LSU, as well as the folks up in Minnesota for sugar beet operations in Minnesota and North Dakota, you can dig into the data and see where costs have gone since the last Farm Bill. Again, I just do last Farm Bill to this Farm Bill just as a good point of comparison. Since that time on a sugar beet operation, and of course this is just for that region, the Red River Valley, it doesn't include Michigan or the western states like Colorado or Idaho. Seed values up 30%, for cane up 44%, fertilizer values up about 66 to 70%, crop chemicals also up. And you add all of that up and you get to an increased cost per acre right now on a beet operation of about $427 per acre. An increased cost of production has gone up by almost $300 for a cane operation since the last Farm Bill. Your average number of acres on a beet operation, this is average, of course you have higher or lower, but about 400 acres on a beet operation. Of course they've got 3 other crops that they're growing at the same time on the other 1,200 acres that they would be growing. But just on the beet operation, their costs have gone up by $170,000. And on a cane operation, average size 1254 right now. Of course, that could be a higher or lower. That's coming out of the NASS database. Increase in cost just since 2018, up $370,000 on an average farm. So again, you need to have prices to support those cost increases, and we've seen obviously prices go up, but they've been steadily coming down, and we'll talk about that in a minute. So as a result of this financial situation that we've seen since 2020, we've seen USDA have to respond to lower Title I supports by increasingly relying on ad hoc disaster programs. This is just up through 2025 forecast by USDA. Now, of course, the government shut down. We don't have the most recent data. In fact, they'll be publishing their 2026 forecast by the end of this week. So we'll see how this looks both for 2025 and 2026. This just maps out all the different programs that they're helping the farm side on. And of course, then we saw this summer we had the bridge program to help us get to the new OB3 Title I commodity program supports. Jim had a similar slide up here. This just shows where the bridge program for a lot of the crop commodities. $11 billion with an additional $1 billion held aside for specialty and sugar crops, which we're waiting to hear about. And that will get actually the farms to the new Title I base acre programs, which is going to ink out to be, when they start to kick in, to be about an expectation of $10 billion a year in Farm Bill assistance. It's a significant investment. Jim had mentioned a number of, over the time period, what we're expecting to see, but you can just see from the national total, those payments are going to be almost $13 billion for this crop year, 12.5 for next crop year, going forward, on average, almost $11 billion in those programs. Of course, that doesn't help sugar, but it does help a lot of farmers that are also growing sugar crops. And for our programs, we'll turn to, again, Jim had mentioned the loan programs, which we are seeing a pretty significant bump up in terms of those loan rates. Of course, the problem being is those loan rates still fall below cost of production for both the raw cane side as well as the refined beet side. So even if we do end up triggering some of those programs in a bad economic situation, that's still not going to make anybody whole. So when we turn to the balance sheet, everybody's sort of been scratching their head, like, why are we in this sort of situation where you have so much sugar floating around in the U.S. right now? So what happened? And I sort of think about this in two ways. Do we get more supply, or are we seeing less demand? That's essentially what I'm trying to investigate here with these slides. So right now, refined stocks, both on the beet side and the cane side, are up about 500,000 tons over your average where we've been over the last 5 years, on average. Of course, you can see that 2025 was inflated as well. That's at the top of the 5-year average. 2026 is starting the year above that. So we're coming into the year with almost 500,000 tons of extra stocks over the average. And that's pushing up our stocks to use numbers. Now, this chart is one that you've probably seen me present a number of times. It shows just where the balance sheet goes, stocks relative to use. We try and keep it in that gray spot between 13.5% to 15.5%, and that's normally where we've ended up. But you can see over the last 5 years, we've been steadily increasing. Last year, almost ending the year at 20% stocks to use, which was, last time we saw that was during our forfeiture time period in 2013, 2014, as well as 2001 when we saw forfeitures occur. And 2025, 26, of course, we're not at the end of the marketing year, but we're still, for this time, compared to the previous 5 years, we're above where we were. So again, the question is where's all that sugar coming from? And a lot of it's coming from imports. We've been having good crops, don't get me wrong. We've been over 9 million tons for the last 5 years, cane and beet added together, but still we're bringing in a lot of imports. You can see here, going back to 2019-20, that was the year we had both a drought down here, but also a beet freeze. We saw a big shock to the U.S. supply, and we did turn to the market to get a lot of imports, which we needed at that time. We imported more than 4 million tons. Since that time period, we've been averaging in this 3 million ton area, and it's a mix of a variety of things. The green there is our normal quota that we give out to our trading partners each year. The blue and the yellow are kind of the interesting ones that have been changing dramatically recently. The blue is Mexico, and you can see back in 2012, 2013 when they dumped about 2 million tons each year on our market. And then we had the suspension agreements which regulated our trade with Mexico, and that's brought them more in line with what we getting what from Mexico, our residual of what we need. But the yellow there is essentially uncontrollable. It's the amount of Tier 2 sugar that comes into the U.S. So any buyer in the U.S. that wants, or any importer that wants to bring in Tier 2 sugar can do so as long as they're willing to pay the Tier 2 duty on it. And we'll talk about that in a minute. Overall, that Tier 2 sugar, you can see it's been growing. Now, where did the Tier 2 duty rates start? They started back when we signed up to be part of the WTO in the late 90s. Since 2000, those rates haven't changed. They were set at that point at 15.36 cents per pound for raw sugar and 16.21 cents for refined sugar. And they've been flat ever since. They're not adjusted for inflation at all, or for costs, what have you. At that time, they could have been set at what's called an ad valorem rate, which would have been a percentage of the world price, but they had decided at that point in time to go for just a flat rate Tier 2 duty on out-of-quota imports. And over time, it's not surprising that as inflation's occurred, as costs have gone up, that you're going to see more Tier 2 sugar come in as it becomes less of a deterrent from bringing in that Tier 2 sugars. Now, the green and the blue here are both the raw and refined. The refined a lot of details there about what's happening with organic sugar imports, which are generally refined sugar imports. But the blue there is the raw sugar imports that we've been bringing in, and that's refined here and sold to customers in the U.S. And it's been being brought in by new market participants. So I'll talk a little bit about this over the next two slides. If you look at pre-COVID consumption, where was sugar going to now, last year essentially, and compare the two. Now that it's up, a little bit, it's up by 2% since FY19, but the amount of sugar going to certain categories has grown dramatically. For example, I look at the amount of liquid sugar demand right now, and it's up by 500,000 tons compared to where we were back then. That's up 34%. It's pretty large increase, and a lot of that's going to the beverage sector, but not just the beverages, but other sectors as well. Now, who's bringing in that sugar? Now, certainly some of our companies are doing that, but a lot of that's coming into what's called non-reporters. That's that red line there at the bottom of this chart. And non-reporters are, just importers that aren't refiners. They're not surveyed by USDA in terms of what their production, sales, and stocks are. USDA has survey authority across any of the participants in the sugar program, and they're typically refiners or beet processors. Non-reporters is the red part there. So you see the imports coming in and you just assume that they're delivered, because why would you, if you're not refining it, you're not going to be bringing in refined sugar and storing it. So generally speaking, non-reported deliveries are expected to be sales immediately. And that, while it looks flat, you've got about 1 million tons coming in. That's about, we always say, about 8 to 10% of the market. As non-reporters become bigger, they become reporters. So they become refiners. So we've seen a number of companies move from this non-reporter category to what's called a reporter, and they show up in cane deliveries. So that includes companies like CSC, Sucromex, Sucro, and Indiana Sugars is a new one. So they used to be in this red line down below, and they've been brought up into the green bar area. And so you would expect that red bar to fall, but it's not. It's staying consistent at about 1 million tons. So even though you're bringing big participants out of that category, they're being replaced by new market entrants. All right, I'm going to pivot real quick to Brazil. Jim provided a lot of information on this. Just on the sugar side, we're seeing on the world market surplus right now. Last couple of years, I got a Zarnico chart there. Those are adjusted daily, essentially. But right now, you can see that the world market stocks to use is growing, and that's pushing down prices. That's a red mark. That red is the number 11 world raw price, and that's very bearish for world prices. And in fact, right now, current prices are lower than cost of production, even in Brazil. So right now, the world prices, the number 11 and the number 5 refined world price, are both below cost of production. And that can't continue. I mean, the only way that can continue is, and this is a chart you've seen before, is if those producers are getting supports from their government. World prices are depressed below the lowest cost of production. And this just shows on average you're below, right now, the world price on the raw side, and this is for last year, even prices are lower today. 6 cents below the average cost of production, and for the refined side, also down by about 9 cents. So again, this is the typical situation that we would see in world markets, but at this point, we're also seeing this fairly dramatic fall in actual world prices, which is pushing down our price as well. And this is a chart that you've seen me and as well, I think Mike has used this chart for some of these presentations to you. Shows the world raw price, that purple bar, plus transportation is that purple bar there. You can see it's been falling pretty steadily since 2023. You add the tier 2 duty on top of that, which is, as I mentioned, 15.36 cents, and that pops it up to that orange line. Now, the one thing that's a little bit different here, a little bit more complicated, is you've got these reciprocal duties, these IEEPA tariffs that the administration has levied on a lot of countries. It's between 10 and 50% if you're looking at Brazil, for example. But by and large, I think it's coming in at an average rate of about 15% on sugar imports. And that puts our price up. That gives that ceiling a little cushion, another cent and a half to 2 cents on top of where we would be with just straight Tier 2 duties. And the U.S. raw price of number 16 is that red bar. So by and large, the theory would be that if U.S. sugar is cheaper than that, which it normally is, the buyer's going to be preferring U.S. purchases. But if ever that red line would go above that orange, then of course it's going to be cheaper to buy world price sugar. Just looking at the new loan rates and what's called the forfeiture levels for sugar in raw sugar. Right now, the new loan rate has been pointed out, got raised, from 19.75 to 24 cents, and that pushes up our forfeiture price to about 27 cents, 27.4 cents. And you all in the room, a lot of you know your particulars for your different companies a lot better than I do. I'm just showing on average, this is where we're using USDA data where we're settling right now, and that's still about 6 cents below where the raw price is. So we're right now looking at these numbers. We're looking like we're still a bit away from that forfeiture level for raw sugar. On the cane side, on the beet side, it's a little bit closer, but I don't have those graphs for you. But I did want to show this example, which is I've got the beet example on the left and the cane example on the right, and this is if you're competing for deliveries to a customer, liquid sugar to a liquid sugar customer, how do they sort of the economics map out? So if you're a company that's melting sugar, you're bringing in high quality raw sugar from Brazil or Guatemala, you're paying the number 11 price, and at this point when I did this it was 15 cents. It's a little bit lower now, 14 cents. You're paying that Tier 2 duty, and again I'm on the right hand side here, the Tier 2 duty of 15.36 cents. You pay shipping and handling, you're paying your reciprocal duty, the IEEPA tariff. You get a total of about 35.5 cents landed, and then you're going to lose a little bit when you melt it and filter it. So that puts you up a couple cents. And the same would be true of a cane refinery that's buying number 16 raw sugar and refining it to white and delivering to the same customer. Now, of course, the transportation logistics are important to consider here. A lot of those melters can barge up sugar up to a warehouse and use dump trucks to move that raw sugar around. And they melt it real close to their customer. They got to refine it, or they got to filter it and melt it and deliver it. So they can deliver at about 45, 46 cents right now to a customer. And if you follow the same logic on for the cane refiner delivering to that same customer, you're about a penny and a half higher than that. Now normally, and this just explains why we're in the situation we're at. We've got a lot of sugar in the US, why we're bringing in Tier 2, why would we bring any more in? You can see that this type of analysis, and these are using sort of example rates, but they're reasonable. You can see why sort of a market participant that's not a traditional cane refiner can still make margin and sell to a customer. Now, in order to become competitive with that melt house, we would have to drop our price by about 2 cents, which is, you can do that if the world price is high enough, or if our number 16 is high enough. But right now, we're already at cost of production, so cutting our sales price to meet that margin is going to be meaning we're going to potentially be losing dollars on those sales. The same would hold true on the refined beet side for customers that are more in the Midwest area. So we've got these IEEPA tariffs that are pushing up our import prices by 10 to 15%. So the one thing on that graphic that can help is you could say, what if tariffs were higher, or what if the world price was higher? And we can't really do a lot about world prices. But we have seen these tariffs from the administration, IEEPA tariffs, pushing up our price by a little bit. It makes that calculation a little bit more beneficial to us. But those are under legal challenge right now. As Jim had mentioned, we're still waiting to see when the Supreme Court's going to rule on that. And as Jim had also mentioned, there's a lot of options, right? The ambassador at the USTR said there's going to be a plan B if that happens, and I've got the same examples here that have been talked about, Section 122, 201, 232, 301, 338. There's a lot of different tariff authorities that the administration and Congress have, and we'll see what happens. They all have a little bit of, whether it's the limit on how long they can be in place or how high they can be, or what needs to happen in order for them to be imposed. There's also, they're not quite as open as the IEEPA tariff authority is, but nevertheless, there are options available. I'm going to turn to demand really fast now. And now we've seen, as Jim had mentioned, the GLP-1 situation affecting U.S. demand, but it's also going to be affecting world demand. So when we're looking at, I just traced through a lot of those economics that start with what is the world price of raw sugar. If those prices stay low, that's not good for us. We need those prices to go up. But if we have the majority of the world's obese people, at least a quarter of them live in China, India, Brazil, and Turkey, if all of a sudden you can get cheap generic pill form drugs that are produced in China and India, you're going to see, again, a pretty dramatic change in world demand. This chart just shows where per capita consumption of sugar has been over the last 10 years, not including the recent phenomenon of these GLP-1 medications. And the white or light colored countries here are countries where you've seen actual per capita consumption of sugar be zero or negative. So even before these GLP-1 drugs, we're sort of swimming upstream a little bit on consumption. In the US, it's been a pretty easy calculation to make in terms of what happens as US population grows. That translates into higher sugar sales for us. Usually it's about, for every million people that the US population grows, we sell about 10,000 extra pounds of sugar. And that, regression analysis that, any statistician can show you has held for quite a number of years, going back to the 2000s. But you can see the last 2 years, or last, I'd say 5 years, have been a reversal of that trend. We've been seeing flat or stagnant consumption of sugar in the United States that have not been tracking with the growth in population. And there's a lot of reasons for that. We talked about some of them. Obviously, inflation has been hitting American households over the last 4 years, and people have been buying less at the grocery store as a result. But GLP-1s are one issue, and we've had a lot of rhetoric on the diet side, certainly over the last year, and we've seen a lot of SNAP food restrictions go in place in a lot of states that affect food and beverage demand, whether it's sweet snacks, or sugary beverages. These are the states that I pulled recently that have some sort of waiver in place that allows them to put restrictions on what folks that are on food and nutrition assistance can purchase. If you just assume that this it's not going to zero out sugar purchases by these customers. I mean, they could easily buy those products that are restricted under the SNAP program with their own household income, and by, it's a question of how fungible this is. But in this example, I just tried to figure out what was the amount of sugar that could be affected in these states by folks that are on those programs. And at least right now, we're talking about, the map is, there's a lot of states that have these restrictions in place, but this would only affect about 57,000 tons on the food side and about 15,000 tons on the beverage side. So we're still talking relatively small amounts of sugar. Jim had mentioned the new dietary guidelines and the school meals program. I worked on some of these calculations with Courtney Gain at the Sugar Association to try and figure out what this actually means for the school lunch meal program and how that would affect sugar demand. And you've got a number of things occurring right now. You have new rules that are going into place for school lunches, and that is the first USDA current column there, and that's not based on the new dietary guidelines. That's just based on the new school lunch regulations that have recently gone into place, and that would lower demand for sugar by as much as 60 million pounds, which translates into about 32,000 short tons raw value of sugar. So not a big hit there, but the new dietary guidelines, should they go in place and be adopted, that could affect almost 250 million pounds of sugar, or 133,000 short tons raw value. So USDA puts out their 10-year balance for the next for all the commodities, and a lot of people don't really pay too much attention to it, but I do. I like to see where USDA is focused on what are the trends for all the commodities, but sugar in particular. So what do they do have, with all of the things that are going on, whether it be trade or diet policy, they still see certainly a dip going into 2026, but after that a return to trend and a growth of about 600,000 tons over the next 10 years. Now, I'm not saying that is the silver lining in sort of the clouds we're seeing right now, but there is certainly question about what will the future bring, and I still think that we're going to be able to find a way out of a lot of this, because despite what you're seeing, there's a lot of studies out there about folks that have been on GLP-1 drugs, for example, and what happens to their purchasing habits at first. Yes, they go down, but a year later, they're back up. So I'm not saying that is all studies, but there are certainly questions about what long-term use of these medications will mean, and I don't think it's going to be all of these sort of doomsday scenarios that we're hearing about right now from the food CPG companies.